Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I really appreciate that. So I was watching this video from SoCal Steve last night, and I was very inspired, and I told him I'm going to make a reaction video from this because he made a lot of good points about this new controversy from YieldMax. And then I watched Marcos, and he interviewed Michael Coe, who had basically a rebuttal to this video, except I think they were filmed at the same time, so it's not a direct rebuttal to SoCal Steve. And if you don't know him, and I'll link this in the description down below, but I respect SoCal Steve. I met him during the NASDAQ closing ceremony for YieldMax in July, and I think that if I had more money, our portfolios would look similar. Unfortunately, I don't have enough capital to support my lifestyle in a sustainable manner, so I am more of a degen than he is right now, but I appreciate his point of view on things, although I didn't agree with everything that he said. So let us go back to the beginning. So YieldMax made this post at a time when the market was going down, and it's been a bad week. I was looking at my portfolio and it's going down, and I'm like, okay, I'm going to go on Twitter, and I just want some people to say, buy the dip, it's going to be okay, like we're doing great, let's just keep doing it, keep your head down. And I get onto Twitter, and it is literally just everybody dragging on YieldMax. I go onto Reddit, everyone is just attacking people that are in YieldMax, and it's not pretty. It's not helping my state of mind and my mood. But basically they said, you asked, you answered. We asked, you answered. Investors want income solutions built for more than yield alone, designed to deliver consistent cash flow and preserve greater upside potential. And so they're coming out with a target 25 ETFs. Okay. I think the biggest pushback to this is people say, we don't want new funds. We want you to fix the funds that you already have. And so for me, well, first of all, we're going to go and actually listen to Michael.
And by the way, when I've often told people that if I could design my optimal portfolio, it would grow slightly faster than the rate of inflation in price and pay out the largest possible distributions while still accomplishing that objective.
So we're all on the same page, right? We just want YieldMax funds to generally grow, beating inflation and giving me the most amount of income possible. To me, that is YieldMax. Everything else is a dividend trap. So for me, just in general, let's go back and talk a little bit about YieldMax's history. So they were the first to market with these single stock ETFs. And nobody knew about it. We didn't know if it was a scam. We didn't know if it was long lasting. And then they reverse split Tesla. And, we didn't know them back then. They didn't have a reputation. So it threw it even more into a tailspin of, are these going to last? Is this a dividend trap? Like, what are we doing? So basically, they were good at that, and we didn't really have a choice. There was nobody else doing it. Then Roundhill comes out, and they start doing weekly pays. Because before we had weekly pays, we really were trying to get funds to pay on different weeks of the month. That way, we can get paid in week 1, paid in week 2, paid in week 3, week 4. But then Roundhill was like, well, what if we just had a fund and we paid you every week from the fund? And then XDTE, RDTE, and QDTE, they were the hot thing because, oh my gosh, now we're getting paid every week from this and we don't have to try to finagle things so that we can get paid a consistent amount throughout the month. And YieldMax was pretty resistant to that. You can actually look at their old videos and go through it. I was actually on, I think it was on Twitter the other day. Retire on Dividends was, I guess he had like a new tool that split things into clips, but I was watching an old clip from a interview we had with Jay, and he was explaining why doing weeklies is an administrative headache and they don't want to do it. And so I get like that sometimes where I get someone pitches an idea for me. Basically, I'm going to use YieldMight as an example, but I've been like this my whole life where my initial reaction is like, you don't need that. Like, I don't want to do that. That's a stupid idea. I like absolutely not. But then I think about it. And then I start thinking about, well, how can I implement what this person's been asking in a way that I think will satisfy the request that they made in the first place? Like, what is the compromise here? So, YieldMax is a business. They can't be like me where I decide that I want to change up my portfolio and I just do it every other Thursday. They have a prospectus, they have what they think. They have to be like a leader. And sometimes, even with the retail investors, and we're telling them, we're trying to communicate clearly what we want. It's their job as a business to go and translate what we say we want and for them to figure out how to implement what we want in a way that is true to what their brand is. So I do believe that YieldMax feels like they are satisfying the I want NAV stability while getting a good amount of income with these target 25. But the problem is, like, YieldMax, sometimes it just feels like they're not listening to us. For example, like, nobody asked for the inverses at first. I didn't really cover them. Now I have WNTR for my hedge. It's done really well as a hedge, so I'm glad that it exists now, but I didn't ask for it then. However, I will push back on nobody asked for the inverses with SLTY because Max Convexity and Jay came up with it on his show. And then when I did my first interview ever with Jay, I asked him about SLTY. I said, hey, I think we're in the middle of a bull market and I'm thinking about hedging and we need to have a product out there that is the inverse, but not an inverse of Ulti. I don't want the exact same things that are in Ulti to be in SLTY. I want the inverse of the strategy. And he said, oh, that's a good idea, and I'll shop it around, see what the appetite is for it, and maybe we'll launch it. And then they launched it. So I feel like I was listened to with SLTY. And I have SLTY, and it's been doing pretty well. I mean, I don't have positive total returns on it. Well, I might have the capital of it is also going down, but it's also an inverse, so it's supposed to trend to zero. So that is a special case. But I think specifically for MSTY, Misty, it's been trending down. Like, really, it's been on a really big downtrend. So if you look here, this is Google Finance. And this is just a growth chart, which we all know is not like the best way to look at income funds. But the dark blue is Misty. Or not Misty, MSTR. MSTY is the next tier down. It's doing pretty well. And then you have MT, like Matey, and then you have MSTW, and then MST. So it's like the inverse, not the inverses, the leveraged ones are doing worse. MST did the worst, which is what I was in. But that's what happens because the downside protection that all of these have, it only protects against one very big sharp downturn. It doesn't protect against like the slow decline of a stock. And so one thing that is being said, it's like, oh, well, Ulti is going down in a bull market. Well, okay, so even in a bull market, first of all, the entire market can correct and have a pullback in the middle of a bull market. So if the market is temporarily down, but like macroeconomically, we're still in a bull market, you cannot expect Ulti to be up when the entire market is down. The problem most people have with Ulti is that it also doesn't participate very much in the upside. And so I think most people do have the most problems with Ulti, and most of the suggestions that I hear for Ulti just make it not Ulti anymore. So I think to fix Ulti, we would have to have like a Gen 2 of Ulti that really is a new fund, and then people would have to decide which strategy they like more. I will say, however, they don't actually have to change anything with Ulti to fix Ulti. The only thing they have to change is around this time last year, they had TQQQ in their portfolio. They could put more funds that have stronger fundamentals into the fund temporarily, and they can put the strike calls more out of the money, which will result in less premium being given to us, but hopefully will have the side effect of raising the price. And that's not going against their prospectus. They don't have to change anything. It's just, I do understand everyone wanting, like, I want a range bound one. Like, nobody wants Ulti above $20. We also don't want it below $5. So if it could just, when it hits, $10, maybe we put in more fundamentally sound things and have it further, because Michael Coe, in the interview that he had with Marcos, explained that they can't generate premiums and keep some of the premiums back because of how regulations are. They have to distribute 90% of what they earn. Okay, well then make your strikes further out of the money so that you can capture some price appreciation and we just get less premiums. It's the same request stated in just a slightly different way, and you've done it before in the past, and I think, I don't think you intended to do it, but I've seen it, and that's what made me, right after you made the changes in October, or I think it was in October last year, just temporarily being in more fundamentally sound companies and build it. Because if I was if I had $2 million and I was doing these cover calls on my own and I lost the amount of money that Ulti is, I would have been in rehab. I would have been, swing trading and trying to get the principal of my entire portfolio up because I can't go down to zero. So I think, you're not wrong if you say Ulti is a dividend trap because it meets the definition. Doing calls on really high implied volatility things, I don't know if I said this before, but even in a bull market, even with the correction and everything, individual stocks in the stock market, even in a bull market, can go down. It's just, and on average, everything's going up in the bull market. And when you have high implied volatility, it's volatile both up and down. And since all of this is speculation, sometimes it's going to go up and sometimes you can get your face ripped off. And so I don't like, I also don't want to have to sit here and go through every holding every single day to understand why is ulti going up or is it going down. I just want to trust that the fund managers will, have custody of it and say, hey, like, we need to keep this above $10. Which isn't what ulti is, but that's what I would like. So, anyways, I did actually make notes. So I was actually in their Twitter space on Wednesday, and someone asked, are you going to make a sub-brand of YieldMax? So that, because we have the single stocks, and the single stocks have their own risks and everything, but a lot of people really like your basket of funds better, like LFGY and GBTY and Chippy. Could you make a brand that just has more fund of funds? And their answer to that was, well, we're trying to make a logical separation within the YieldMax's new rebranded website. And internally, apparently, they're calling it YieldMax Prime. But I personally think that they should call it YieldMix and Max. Because even Michael Coe, because they keep saying they don't know why Biggie is not more popular. If you want NAV stability in a fund, just pick a fund of funds or pick something like the Target 12, and that'll have better NAV stability. The biggest problem with Biggie, and he kept comparing it to the S&P 500, like we're beating the S&P 500. Well, no one uses the S&P 500 as the benchmark for an income fund because these are for income. And so I'm going to try to compare it against things that have a similar distribution. So, like, just off of the top of my head, you have Biggie, you have SDTY, XDTE, QQQI, EGGY, SPY, and XPay. So, with Biggie, you would have $11,096. SDTY, XDTE, you would have, less, but it's based on the S&P 500. QQQI has just like rounding error less than Biggie, but it's based off of the NASDAQ 100, and it has a good reputation of keeping the NAV stable because it's NEOS. But then you have EGGY, which pays like a 24% distribution, and that has $11,500. Well, personally, and EGGY does have a good reputation as well. So, like, I would lean more towards, EGGY or XPay or QQI or XDTE. Like, something that has, I think EGGY is also a EGGY Nest Yield. So I think this is not the S&P 500. I think high without sacrificing growth potential. 25%. Okay. So they are also doing like a 10 to 25% of. So this is like a non-degenerate ulti. I was going to say this is like, because Biggie is 50, the biggest 50 companies. EGGY is even more concentrated, but they are yielding 25%. So I think EGGY is actually a competition for the single stocks that are the 25% that YieldMax is coming out with, because this, like, even Michael Coe was saying the intention of YieldMax was for you to get basically into every single one of the single stocks yourself and manage your concentration in each one of these yourself. But as I've been in this, as I have, been in this space for a really long time. Also, I started this channel. I'm bad financial decisions because I didn't want to have to sit here and try to convince you that I'm an authority figure, that I know what I'm talking about. I was skipping all of that. I make bad financial decisions. We're making bad financial decisions together. Let's just jump into this and I will tell you my opinion and you can make your own conclusions. But I am saying, as someone that has been talking about this every day for more than a year, that, like, I really feel 25% is arbitrary for these single stocks. I really want like a Havy where they choose a percentage outside of that stock's implied volatility. So if Mr. has an implied volatility of 80%, maybe they shoot for a 70% return. Something like just enough out of the money so that we get some price appreciation. Although I am going to say that I'm not as concerned about YieldMax's single stock ETFs. I know that some of the stocks that they have, like, they're really good swing trades, but they're not really that good for cover calls. But I have been in Misty on those days where, it's been down, 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 and then it goes up like 20%, MSTR goes up 20%, and Misty goes up like 18%. That's fine. We're getting like 100% distribution at that point. So I think that YieldMax has changed their prospectus enough for the single stocks, but I don't know if the target 25 is going to get the adoption that they're hoping for. And the only the lower the distribution is, the more competitors you have. And I think people just want like the protection in all the time, the call spreads all of the time, because like I want to trust the fund managers to put on the protective put, or not puts, but like the call spreads in the times when it's called for. But otherwise, it's just having less distributions to me as like for no apparent reason. So I don't want to have to go to totalrealreturns.com to convince people that something overall is a good buy. But MSTR has had a terrible run of this. So based off of from September this year, September 23rd, which is not that far away because MTYY just came out. But Misty in total returns is giving you more returns than Mr. if you reinvested everything. And it has the highest total return in this list if you still believe in strategy. And if we take out MTYY because it is such a new fund from July of this year, it's not, you don't have $10,000, but you do have more total return than Mr. in a down market. So it's one of those things where if you believe in YieldMax, in their single stock ETFs, I've been, well, let me finish that thought. So I like Mr. I want to be in every single one of these strategy related ETFs. I think being in every single one of these will have shine in a different market. And so it somewhat spreads out the risk. But personally, I have been more drawn to let me drink something. So lately, I've been kind of affinitizing myself more towards the fund of funds. I would rather be in like LFGY, Chippy, GPTY, things like that, where you have more than just the one chance, more than the one stock. We're paying the fund managers to manage the holdings within it. I think, like, it's just really hard as an individual investor to manage like 30 positions in things. So I would rather have, like the WPAYs of the world where, and now we're having ULTI and KYLD. There's still appetite for, I want a diversified basket of things that are not necessarily the S&P 500, but are like good, fundamentally sound stocks that I can go ahead and like what I want, like Michael Coase is satisfied with, I want to beat inflation and get as much premium as possible. For me, year to date, my margarine account, I have returned a 20% growth, right? The S&P 500 year to date is at 14%. Okay, well, I am beating the S&P 500 and I'm averaging like 100% yield. So like, and don't copy my portfolio. Don't try the things I'm trying. I'm just putting that out there as an example of, I want to be able to trust YieldMax to beat the S&P 500 and to get me as high of a yield as possible. And if the as high of a yield as possible is 25%, then so be it. But and a lot of the better funds, like better built, better for your NAV stability, they are, the 15, 20, 25% funds. But it's just like, I think it's going to be an interesting experiment for YieldMax. It's not exactly what people have asked for. And so I understand the pushback that YieldMax is getting, but that doesn't mean that I'm not selling puts on Misty, because even if I bought a Leaps on MSTR and I started selling my own cover calls, I am not getting 100% from that, because I'm going to put my calls further out so that I don't have to spend money to close a call that's gone bad. So, and I'm just a retail investor. I am not an expert on doing options. I do them sometimes, but like, I'm definitely not an expert at doing options. But I do like the options on Misty, because the worst case is I own Misty for $10 and it pays a weekly distribution, and I could sell cover calls on it or a portion of what I have on Misty and get some of my money back. So I do like that YieldMax is democratizing doing options, because like, you really do need like a really, really large portfolio to not have an outsized portion of your portfolio in cover calls. And so if you want to be, in YieldMax and have, 30 of these going on, like being 30 different positions and actively manage it yourself, you can do that. Or you can just be in YMax. But I do believe ULTY gets the most flack and people are the most anxious about that, because I think it is an exciting experiment. And one thing that Michael Coe said, if they reverse split, and they can have ulti stay in a range between like $10 and $30, people want to do options on it. Like, just like I'm selling puts on Misty, I would not mind selling puts on ulti if it was more than $5 at the moment. Like, if it was a $15 stock, that means that you would only need $1,500 in your account to do options on it. And so getting stuck in a stock that pays you a 90% distribution while you do cover calls on it, that's really not that bad. Like, that's actually a good scenario. So if I hope that YieldMax caves in that they take a look at their prospectus, and it doesn't have to be anything super flashy or grand. Just update your prospectus to say you can do further out of the money calls, be in companies that have better fundamentals, just quietly get ulti above $10 and maybe up to $15, and then do what you wanted to, what the original purpose of it was, is go into highly speculative things and try to make winners out of these highly speculative plays. So I just wanted to also say that it's not YieldMax's fault that, I got laid off and fired and I put 30% of my portfolio into ulti. Literally, nobody thinks that's a good idea. Not even the fund managers at YieldMax. They do not want us to be taking out HELOCs. They do not want us to be using margin and doing this stuff. It's not good practice. So that's why on Friday I wound up just my last video. Basically, I put 1,000 shares of ulti in my leverage trash account. I cut off MST to 1,000 shares, and like you can see that like my portfolio in my margin account already recovering. So I think when you're using margin, you do need to be in lower beta things. And ulti and none of these single stock ETFs should be like, you do need to have a well-diversified, well put together portfolio, and that is your responsibility. And like, single stocks do have a risk. I just would also like to push back on the narrative of YieldMax funds go down over time. The thing is, these are all momentum plays. So with stocks, they don't always have momentum. They do have, months where they're not doing anything. They have months where they're pulling back, and then they shoot forward. So whether that means that they're a good candidate for a cover call strategy is like a different issue altogether. But for me, like, I still like Misty. I still like MicroStrategy. They're going through some things. Winter is coming. I've been saying this, I feel like for like a year, where I've been hesitant to really build on my crypto positions because winter's coming. Why would I pay more than I need to? But yeah, so I'm guilty of over concentrating myself into YieldMax funds that are single stocks and not diversified. And it's really not YieldMax's fault. But now we have other funds, and we have fund of funds, and we have things that I just think it's true that I don't have the alpha or whatever of single stock picking where I can make the good call 100% of the time. I would rather be in something like a WPay or Eggy, like things that are fund of funds, and that way if you have a few of the stocks that are going down, then you have the rest of them to bolster up the overall NAV. So I don't think any of these have zero NAV erosion because of the definition of what NAV erosion is. I just don't want it to be like the cannibalistic type of NAV erosion and like it's bad and nothing's ever going to recover and I just threw my money down the drain basically. So for a strategy specifically, I've been saying this for a really long time that we're heading into winter or we're in winter, something about winter. We're definitely just between halvings right now. So I'm viewing this as my accumulation of Bitcoin and strategy phase. It might not be performing at this exact moment, but hopefully Misty and all these other things will be around in 3 or 4 years when the halving is happening and it gets the really big run up and then I can sell at least for a profit. To me, that would be exciting. So like that's the bet I'm going with. So I'm not expecting Misty to perform miracles and be up when strategy is down. I would love for it because I've seen it in the past where strategies run up and Misty's been within 1 or 2 percentage points. Like it didn't get capped that much because we had the call spreads. So I just think that people's risk appetites are basically going down as we have a choppy market. So yeah, I feel like I'm looking at my notes. I have liked Ulti for a really long time. And I've been tax loss harvesting on and off basically this whole year, Ulti. And as like a concept of an experiment, yeah, I want to have a basket of like the most speculative things and I just want to see how it does. And Ulti's there to remind us like don't be in 100% speculative stuff because it's gonna go down over time. And options, when you do them yourself and you're being that aggressive, it can be quite expensive. But the goal is for like your total return to be more than what you're spending to try to keep your principal the same. So I think the market is evolving. That for me, YieldMax, what is the maximum yield? It's not the total return value. I can agree with Steve on that, where I want the maximum amount of yield that I can that beats either inflation or the S&P 500 and get the most amount of distributions or premium back from the fund so that I can do whatever I want with the fund. I'm early retired right now, more or less. I need to be able to use these funds to pay, my credit card debts and my personal loan and my trailer off and just like literally all the things that I have that have been backed up. I need to be able to live my life with these distributions and not worry about the principal going down so much. Or if it does move with the market and the underlying, have faith that these fund managers are going to at least understand the assignment of I need my money to recover and I need generally like this amount of money in order to live off of it. So I think, yeah, we all just want to be able to look at a growth chart and say like, yeah, I'm beating the S&P 500 and I've gotten, a 30 or 40% distribution. So that's why I didn't immediately, it wasn't intuitive, the target 25. They're hoping that like, MSTR, it has an implied volatility of like 60%, if we're targeting 25%, then you should be seeing some price appreciation when Mr. recovers. Okay, but what if MSTR's implied volatility goes below 25%? Then you're just cannibalizing the fund. So, for me, and I said this before, I think doing a percentage off of these particular tickers implied volatility would have been better than just arbitrarily picking 25%. Because if strategies implied volatility is 80% and we have a halvey, which is we're targeting a 40% distribution, so then we get 40% of distribution and we get price appreciation, I don't think anybody would be complaining about that. So, and I keep saying halvey as like the ulti version of, well, let's, get into things that have good fundamentals but have relatively high implied volatility, but we target half of the implied volatility. And that way we're getting, 20 to 30% distribution, but it's also has price appreciation. And I don't want them to copy other people, but, having, a quarter to a half of it being in the underlying, just so that, or having it uncovered, that way we do have price appreciation. That could be a way to achieve the same effect as well. I'm not a fund manager, so I don't and I don't have a clear idea of exactly every single one of the regulations that they have to go through, but seeing other funds that have implemented things that might not always 100% shield you from the downside, but things that I have more faith that when things recover, it'll participate in the upside. For me, that having trust in the managers and having that reputation is also very important. So, anyways, what are your thoughts on this? Do you think YieldMax keeps not they seem kind of resistant to change, even though they are out here and communicating and make themselves extremely accessible. And do you think that they're not, they've heard the question, but they're not answering it in the way that you want it to? Anyways, I wanted to thank Russell, Paulette, Scott, Michael, Shane, Bill, Patrick, Spalding, BGP Automotive, in my opinion, Jetta, and Omega Werewolf X for being members. You are amazing. Thank you so much for making your bad financial decisions together with me. And I'll talk to you later. Bye.